No, this is not clickbait, and no, I'm not biased because I'm a realtor. In fact, I actually first called this in a video in September of 2022 when other realtors were telling people, no, the market's not gonna crash. Rates are going up a little bit, but we've still got low inventory. Well, today I'm gonna show you exactly where the market has crashed or has quote unquote finished crashing or finished softening. I'm gonna tell you why we're not likely to see more pain in the markets or why we're not gonna see a lot more downward price trajectory. We might see a little bit, but I'm gonna tell you how to account for that when you're making your offer or when you're purchasing. And I'm gonna tell you why the trajectory over the next 4 to 5 years is going to be, in my opinion, a very solid buyer's market. And if we get a Fed pivot, what's gonna happen as a result of that could send prices higher, which would in turn make this an excellent time to buy in retrospect when you're looking at this 5-10 years from now. This is also not just me talking or giving my opinion. I'm actually gonna back it up with data because all my opinions are based on data. I look at Fred economic data, which is public data that you can look at, and I'll actually link where you can find this data for yourself in the description. And although I'm only going to be covering a handful of cities in this specific video, if you have a city you'd like me to cover, link in the description, and I will make another follow-up housing market video when I get enough new cities that people want to know about, whether it's several cities in the Midwest or a bunch of cities in a certain region, and I can make those videos for you, but I just want to make sure there's enough demand. So if you have an interest in a city, because I didn't cover it in this video, go ahead and leave that in the comment section, and I'll be sure to make that video for you as well as to link where you can find this data for yourself if you want to do research on your specific market. So first off, let's talk about, generally speaking, before we dive into the data and I show you the data, what causes a housing market to go down in price? In September of 2022, when I first called this, and my predictions when this was happening was actually that summer would have been the height in terms of prices, or at least the local height. And the thing is if you look at the chart of real estate prices over the course of a 30-year period, they always go in price over a 30-year period, even a 10-year period. People who bought at the height of the market in 2008 were actually able to recover and sell with a profit if they had waited till sometime between 2014 and 2016, which is only a period of 6 to 8 years. So from peak to trough, the market actually recovers quite quickly, relatively speaking, in the grand scheme of things, which means that if you buy today, even if we're not at the absolute bottom of the market, if you buy a house today that you can afford, right now, when you look at macroeconomic conditions, I'm going to tell you why it's actually a good time to buy because of where you're positioned. You see, if you had bought in 2021 or 2022, like I bought my last property, I have not been buying properties since 2021. My last purchase was September of 2021. And the reason it was still a good time to buy then, even though I knew I was overpaying for the house, I'm definitely not upside down in my house now because we did put some money down. We've also done a lot of improvements and we're in a desirable area with a decent view. And so as a result, there's some intrinsic characteristics of the property that make it valuable. And that was actually my first time buying my primary residence. Before that, I was only buying investment properties, which a lot of people think is weird, but that we had very low rent while we built up inventory of other assets that were spitting off cash flow. The whole reason that I wanted to buy a property, even though it was September of 2021, I knew it was basically the height of the market, in my opinion, in terms of where prices were. They technically continued to go up until the summer of 2022, but sales fell through the floor in 2022 in terms of volume of home purchases was down substantially because a lot of people were spooked by the Federal Reserve raising interest rates. Because what we thought, or at least what I thought as an investor when I was looking in the market, the reason I was still prepared to keep buying was I was looking at what the Fed was doing. The Fed started raising interest rates at the fastest rate in history, and we didn't think they were going to do it. And I say we, collectively referring to investors. And the reason we didn't think they were going to do it, and a lot of people in the media and everyone was talking about it, was because is actively bankrupting the United States. Now, the United States is actually bankrupting themselves, but the reason it would bankrupt the United States is because all the debt that we have outstanding, all the debt that we have to continue to finance, because the people who run the government are total retards, is now at interest rates that are not at 0% or near zero like they were for literally a decade when the Fed was keeping rates specifically low around 0 to 2% for years, because quite frankly, the government couldn't afford to pay interest. And so the fact that they raised interest rates because they had to control inflation, because we had rampant inflation that was out of control, and that's the reason they raised those interest rates. That slowed down home sales, it slowed down financing, it made everything more expensive in terms of financing things. And so as a result, that slowed down purchasing, started to slow down the economy, potentially to slow down inflation. But now we're in a cycle where we're in an easing cycle where the Fed has started lowering rates, and we're already down from 4.5% all the way down to 3.5%. And that's a full point over the past few years that rates have dropped. And right now, when you look at current macroeconomic conditions, you have a President Trump, that is for lowering interest rates. He even opened an investigation against Powell. He wants interest rates lowered so bad. And the whole reason he wants them lowered is because as a nation, he knows we can't afford it. And I'm not talking about the private sector. I'm talking about as a country, we cannot afford to finance our own debt. And that's what the Fed rates dictate. And although they don't directly relate to mortgage rates, Treasury bonds compete with mortgage-backed securities as an investment vehicle. And all that means is that mortgage rates will typically be a few percentage points above whatever the federal funds rate is. So that's why it does matter. And that's how it indirectly affects mortgage rate. Basically inevitable that interest rates are probably going to come down at least 1 to 2 more points under President Trump's term, especially because he has a new Fed chair being appointed. What does this mean for you as a buyer? Should you wait until interest rates lower? Well, let me explain to you how these cycles work. You might not remember how crazy the markets were in 2020 and 2021. And if you're not old as dirt like me, you don't remember when I was actually just a young buck from 2005 to 2008, or really 2003 to 2007 was when the market was absolutely out of control. I remember it. And that was a different reason that we had that bubble that created and was burst. It wasn't just because interest rates were low. It was also because there was financing products out there that today are illegal and you can't do because they created a whole systemic issue where you had all these bad loans out there that people couldn't afford. And so that's why we had a massive crash. The reason we're not having as big of a crash or a systemic crash like we did in 2008 is because all the debt that's out there today is actually good debt. One of the most recent statistics I read was that 64% of loans right now currently have an interest rate below 4%. And what that means is that 64% of the homes out there have a mortgage that is affordable. It's at a low interest rate, and so they can afford to live in their house. Whereas in 2008, you had people who couldn't afford to live in their house. And so if you're thinking, well, that's great, this is great information, I'm just gonna wait until interest rates come down further, and then I'll be in a better position to be able to afford to buy a home even more, just because rates will be lower. The reason I would advise you against that is not because I'm a realtor, although I will say I've never met a realtor besides myself that's ever said anything besides, it's a great time to buy. But the reason you don't want to wait is because that's when everyone else will be getting back into the markets. You see, do you want to compete in a tight inventory environment where there's not that many homes to choose from and interest rates are super low and everyone's putting in offers that are 10K, 20K, 50K, 100K over asking just to try and get into a house because interest rates are low and it's a super competitive environment? Or would you rather buy now when it's a strong buyer's market, sellers are offering concessions out the wazoo, and it's simply not as competitive of a time to buy, which means that there might be 3 or 4 homes you're able to find that you really like, and you can get a really good deal on those homes by simply putting in an offer that's a little bit below market. And there's a strategy for how you can approach this that I'll tell you about how, if you want to buy a home, it's very simple of how to actually get a good deal on a property, especially in today's conditions when we have a very strong buyer's market. But before we dove into the data, I really just wanted to give you a high-level overview first of why now is a great time to buy. And I'm going to show you the data, and you can let me know what you think, and you can make a decision for yourself. All right, so I'm going to be going through actually 7 different markets, and the first market I'm going to look at is my home market. And the reason I'm going to start here is obviously I'm familiar with it and I've been watching it closely. And one of the markets I'm actually going to cover in this video is actually a market where we're seeing a lot of stability. And so we'll talk about that because I want to show you that this is why, just because I'm showing you these markets are specifically markets that I knew were going to crash. These were markets that were in a bubble. It was obvious that they were going to crash. And it was obvious because you could see rapid price appreciation. All of these markets had ultra low inventory at the time, which is just always going to cause price appreciation because you had a lot of people moving there and a lot of people buying homes. And so that's going to cause price appreciation because that's basic supply and demand economics. But I do want to show you that I'm not so biased that I'm saying this across the board. I'm saying this is market specific. So again, if you're in a market that I don't mention here, drop it in the comment section and I'm happy to make a video covering several other markets so you can actually see where your market stands. So the first market I'm looking at right now is Denver. And the first metric we're looking at right now is active listing count. Now, the reason active listing count is the most important thing that I like to start with is because the whole narrative that we heard in 2020, 2021, and even when things started to soften in 2022 and 2023 and realtors were trying to sell you that things weren't crashing when they were, the truth is that the narrative was, oh, we still have ultra low inventory. Well, as you can see from this chart, that inventory started to correct itself in the summer of 2022. And it continued to correct into the summer of 2023, really started to correct into the summer of 2024 until it finally has now peaked in the summer of 2025, where in Denver, we have record inventory across the board. This is the most inventory we've ever had going back ever in the history of the housing market. So this is a very, very strong buyer's market in Denver, which is good news for you. Again, if you're in the market to buy, I'll tell you how. So that's the first metric we're looking at. Now, the second we're going to look at is days on market. So what happens when inventory starts to flood the market is there's more choices for buyers to choose from. And then the way you can tell that you're starting to be, in a market correction is because things start sitting. Things don't sell as quickly as they did when you were in a strong seller's market where there was lots of competition and low inventory. And so we look at here at median days on market in December of 2021, which was arguably, towards the end of peak. You can even see in March and April and May of 2022, average days on market in Denver was 9 days on market. Things were going under contract in 9 days. Well, in May of 2022, just off the top of my head, interest rates were still around like 4%. So people were still buying. They were buying at the height, but they were buying because rates were low. And that was the narrative that a lot of people were pushing. When I saw the rate tightening cycle start, I knew things were going in a direction where there was going to be correction. Now you look what happened in 2023. So January 2023 days on market peaked at 62. Now the reason there's always these cyclical peaks or seasonal peaks is obviously people sell their homes at different times of the year or buy their homes at different times of the year. And so right now in January, you can see 64 days on market, and then it peaked at 78 days on market in December of 2024. And now in December of 2025 is at 79. So it's, even 1 day higher. And again, if you go back decades, this is a record amount of days on market in terms of things are sitting right now. Things are not selling, and it's because we have so much inventory to choose from. And the last thing that has to happen in order for prices to come down in the middle of a crash as well, prices have to come down. And that brings us to this chart here where we're looking at median list price. And so if you look at median list price right here, May of 2022 in Denver metropolitan area, 695 grand. Sellers were really stubborn going into the next year. Median list barely came down to 682, but sales were very low. So the following year, we are at 636 in May, and then down to 609 or 600,000 in May of 2025. So that's $100,000 price cut, which is about from 700,000. That's about 14% drop. And right now, again, median list is always lower in the winter because there's less people buying. Right now, it's down to 557. And so things are rapidly, they have gotten more affordable. So if you're sitting on the sidelines right now and you're thinking, I don't want to buy. Oh no, things still seem expensive. I'm going to talk about how you can get into something that is more affordable because I agree with interest rates. Medium priced home being at 560 grand, you have to make well over 100 grand a year to afford this as a single person or household income. It's pushing close to 200 grand because you're talking about a mortgage payment that's, $4,500 a month after property taxes and insurance. It's not cheap, even at 600 grand, even though that's a 14% price drop. What do the rest of the markets look like? Well, let's look at the next one is Phoenix. So what happened in Phoenix? We had record low inventory right here from 2021 to 2022, shot up in October of 2022, and that's because things were sitting. And then it's actually stayed kind of around this area, and it actually hasn't been this high since 2019, going back to 2016 when the market was a little bit softer in Phoenix. But we have record inventory again. May of 2025, it was up to 20,000 units for sale. And Phoenix is a little bit different market because people don't shop there as much in the summer because it's so freaking hot. And then if we look at the days on market in Phoenix, you can see days on market has gone up. And although they're not as high as they were in January of 2023, things are still relatively high in terms of being around 70 days on market. So, things are still higher than they were in 2018, higher than they were in 2019. And that for Phoenix has been what's caused, these price declines, which Phoenix hasn't seen as big of a decline as some of these other markets. But you can see during the pandemic, numbers where median list price was somewhere around 450 to 475, went as high as 550 in May of 2022. And then now it's come down to around 520 to 490, 480, and things are starting to soften a little bit in Phoenix. And part of what is supporting the Phoenix market is you still have net positive migration. You still have people moving to Phoenix, but prices in Phoenix still have, in my opinion, a long way to go. But if you need to buy something in one of these markets, it's as simple as just getting a better deal on the property, because there are sellers out there that are realistic and have adjusted their prices for housing affordability indexes, meaning that their home is priced to sell, because when you have a competitive market where there's a lot of inventory, you need to make sure that your home is priced to sell. Now, this is another market that went crazy during the pandemic. This is the market of Austin, Texas. Now, as you can see here, 2021, 2022, record low inventory. That inventory has since climbed. As of June of 2024, it became record levels of inventory, and it climbed even higher to 13,000 units in July of 2025 in Austin. So that's record inventory in Austin. And if we look at the days on market and what this did in Austin, you can see right now, days on market are up to the highest that they've been on record at 88 days in December of 2025. Now, even though seasonally, things always go up this time of year, you can see that's higher than it was in January of 2020 before the pandemic, January of 2019, January of 2018. 2018, and even January of 2017 at 74 days. Now we're, at 88 days. And so things are definitely slowing in Austin, which explains why housing prices have crashed so much in Austin. So if you look at where we were in 2020 prior to the start of the pandemic, 363, 375 was median list price, and that went up all the way to $630,000 in May of 2022, where the market peaked, and it just shot up like a rocket. Since then, it has now come all the way down to $462,000. You're talking about a price cut of pushing 30% or past 30% if it's not already there. That is a huge, huge price drop for something to go from 630 down to 460 in terms of your median list prices. So if you're in Austin, this is something you want to have on your radar, because things were not affordable 3 years ago, but things are becoming more affordable now. And again, what happens is the market turns quick. So do you want to be putting in an offer in Austin the next time, there's that interest rates are, 2, 3, 4% and everything's really affordable and there's low inventory because everyone's trying to buy? I don't know about you. I'd rather be buying now and just getting a good deal by asking for a discount when I'm purchasing a property versus just having to wait till everyone is out there doing it. So this next one is Dallas. So Dallas was another market that was hit during the pandemic by record low inventory. You can see here it was some of the lowest inventory on record, and now back up to some of the highest inventory on record, 31,000 units in July of 2025. So it's no secret that when we go and we look at days on market in Dallas, we're going to see the same thing. Things are sitting a little bit longer, although it's not as exaggerated as it was by comparison with Austin or even Denver. And then when we look at median list price in Dallas, we can see that median list price, because of all the added inventory, it peaked in June of 2022 at 490,000, and now it's back down to 412,000. So it's almost a 20% price drop in terms of median list price and where we're at. 20% you have to look at. Just because 20% is a huge drop, I know it doesn't feel affordable, but unfortunately the government's retarded and they printed trillions of dollars. So things aren't going to get cheaper. But if you look at the price of a home in terms of it's how much it costs in terms of ounces of gold, or how much home you can buy in terms of Bitcoin, or how much homes you could buy, and you compared it to 2020 or 2021, things have actually gotten cheaper. It's just, if you're comparing it to the US dollar, it's always going to be more expensive because these morons keep printing money and debasing your currency. All right, and then we have 2 more markets that I'm going to go through right now. Quick favor though, if you're enjoying this content so far, please hit the like button for the algorithm and consider subscribing. And again, if there's a city that you want me to cover that I have not covered, let me know in the comment section and I'm happy to cover that city for you. So right now we're looking at Miami. You can see here, this is active listing count Miami. It's the same story, right? We had this record low inventory in 2020, 2021, even into 2022. Inventory didn't pile up, and it didn't start to pile up again until 2025. But when we look at days on market and some of the other metrics, you'll see that we still had, this isn't a record amount of inventory for Miami, but it's back up towards these high record levels. When we look at the days on market in Miami, you can see that the last time they were this high was in the thick of the pandemic, just when we started coming out of quarantine in June of 2020. And then days on market crashed because everyone was moving to Florida and Arizona and some other places like Texas, where you didn't have to wear a mask because they were trying to get out of their Nazi states that weren't trying to put them in gas chambers inside their house. No, I'm just kidding. Anyways, it's right now, it's August 2025, 90 days on market. And if we look at the last time pre-pandemic, we don't even have anything on this chart showing 90 days on market for Miami. And so that's got to be a strong indicator, but not as strong of an indicator as what's happened with listing price in Miami. And so if you look at what's happened with list price, you were pretty steady in Miami for years with median lists somewhere around 400 grand. Things were cheap, things were affordable. Then boom, like a rocket ship in February of 2021, things took off, median list price went way up. A lot of people moving to Florida for the American dream of freedom, of no, trying to get away from California. And then at median list went all the way up to 625,000. And now, although it's not down to pre-pandemic levels, which I'm not surprised because again, the government printed trillions of dollars, so why would it? We're at 500,000. So that alone, that's over a 15% price drop, which is very substantial in terms of when you look at these charts. Housing is not supposed to trade like a stock. It's not supposed to be this volatile. It's a house, it goes up. But some people will pitch you on the fact that it's better than renting, which I would suggest buying an investment property and something you can live in at the same time, but that's just me. And then we'll do one more market that's crashing. That's also a market in Florida, just because I want to send this point home for you. And then after that, we're going to go to a market where things have actually stayed steady and not come down in price. And we'll talk about why that is. So right now we're looking at Tampa. You can see same thing happened in Tampa. Tampa went crazy during the pandemic because we had super low inventory. These are all our inventory numbers of homes for sale. And right now in November of 2022, it went up to 11,000 units. In August, it went up to 16,000 units, and then which was a record at the time. And then now May of 2025 2025. We have 20,000 units. It's the highest on record ever in Tampa in terms of actual available inventory. When we look at what this has done to days on market in Tampa, you can see we have a record days on market. 80 days on market right now is how long things are sitting. Even in September, at the end of, kind of the busy season, 79 days on market. And that's higher than a lot of these pre-pandemic levels. You look at 67 days is basically the height that we saw in January of 2019. 2017, it was 67 days on market. So we're 13 days over that in terms of how long homes are sitting. And when you look at what this high inventory has done, coupled with homes sitting longer on the market, you can see same story. June 2022, things peaked at 449 and then came down to 399. So that's only actually about a 10% drop, which is not that bad, but still things are coming down, or 13% drop, I believe. So it's a little bit over that, but things have definitely started to soften in Tampa. You have record inventory. Things are probably going to keep coming down. And like I promised, I'm going to talk about a city that actually doesn't meet this narrative and isn't crashing. And a lot of cities in the Midwest are like this. A lot of cities on the East Coast, different parts of the country where there wasn't a bubble, there wasn't a massive influx of migration and driving up housing prices, has made it so that some markets are actually unaffected because they didn't have the same factors that were causing things to go up in price. And that is none other than the state of New York. Now, if you look at New York, we're going to start with what's going on from an inventory perspective. Now, when you look at New York right now, you can see pre-pandemic, just looking at the chart, you can see we haven't even gotten close to hitting pre-pandemic numbers in terms of inventory for sale. So it's record low inventory. You do have some scarcity built into the city in terms of that you can't build anymore. And so when you look at what's happening with median days on market in New York, you can see same thing, that days on market is actually down in New York. January 2020, it was 100 days on market. Right now we're December 2025, 78 days on market, 87 days on market. That was in January of 2025. So days on market's actually coming down because a little bit more balanced market in New York. It's still an uphill battle because we're still dealing with the same interest rates everywhere, so financing is more expensive, but you have some foreign buyers, you have people that aren't using financing, especially in the city. That's going to obviously make the housing market more balanced. And then when you go ahead and you look at price, you can see median list price in New York. You can see, and this is not in the city, this is obviously in the state. So we're looking at the whole state. You can see prices are staying steady. Prices are staying a little bit elevated because the inherent underlying market conditions in New York have been favorable for it to be a balanced market, or maybe even a little bit of a seller's market at times. Now with interest rates as high as they've been, but we're still in a market where there's people buying, and that's driving up these median prices, or keeping these median prices elevated to where we're probably not going to see a big correction or a big crash unless we see net migration loss and people moving out of the state. If you're not in one of these markets, which a big portion of the population doesn't live outside of these markets, let me know in the comment section and we'll make a video about that. What if you are in one of these markets and you're a buyer? How do you address this, right? How do you go out there, and what is the best way to go about buying a home in 2026 with interest rates that are still elevated? We're still seeing mortgage rates around 6%. Some sellers are still very stubborn. You'll see some sellers that are trying to get a price for their house that their neighbor got in the summer of 2021 in the middle of the pandemic when everything was outrageous and interest rates were at 3%. It hasn't clicked with them. They're a little slow or dumb, and they're not going to change their price, and that's that. They can just let their house sit for 6 seasons and find a realtor to keep listing it for them. The bottom line is, like, how do you deal with this? Well, it's pretty simple in my perspective. Number one is you find a property that is close to what you can afford, that you like. If you don't like the property, it doesn't matter. And the reason you want to be able to afford it today, if your realtor is pitching you on, oh, you'll just be able to refinance later, don't bank on that, and I'll tell you why. Yes, do I think interest rates are going to be coming down based on the trajectory of the Fed and what's happening in the market? Absolutely. I would be shocked if interest rates are at least not in the 5s or high 4s within 1 to 2 years. And what that means for you is 2 years from now, you should be able to refinance. However, and this is the caveat, if you buy a house today and you overpay for it because you put in an offer at asking, which I wouldn't do in today's market, if you're in one of the markets that we talked about here where there's obviously an elevated amount of inventory, you're going to be able to find a house that you love that you can get a good deal on. And then in a couple of years, you should be able to refinance. But the key when you go to refinance is that you need to have at least 20% equity in your house in order to be able to do a refinance and refinance into lower rates. But here's what that does in terms of your payment. I'm going to give you an example today. A $500,000 house at a 6% rate is around a $4,000 payment. I'm using ballpark numbers, using property taxes and insurance. When that interest rate drops to 3.5%, or let's say 4%, you know how much that payment is? is closer to $3,000 or under $3,000. Right now I have a property I bought at 500 grand. Our mortgage was 2,700. Property taxes and insurance, they go up every year because insurance companies are assholes, and the, city assessor's not much better. And so now the mortgage on that is up to 2,900 from 2,700 when we bought it. To rent that place would be about 4 grand a month because rents have gone up. And so the whole concept of prices going back to what we saw in 2019 or even 2020, I think that would be the absolute lowest that we see prices go back to, but I wouldn't bank on it. And part of why I wouldn't bank on it is that if they keep on easing and dropping interest rates, home affordability is going to become less of an issue, and there's going to be more people that can actually afford to buy a home, which means there's going to be more competition in the marketplace. And if you're looking at these prices with wishful thinking, hoping they come down another 50%, just sitting on the sidelines, you're just as stubborn as the sellers that won't lower their prices, that are asking, 2021 prices. But there's a lot of reasonable sellers out there right now that are willing to price their properties at market value, and they're not commanding the same premium that they were in 2020 and 2021. And so that's why it's a good time to start thinking about buying, because things have started to reverse course. And like I said, I'm not this guy who's been saying this the whole time. You can look at I have videos on my channel from September 2022 where I'm saying it's official, the housing market crash has started, because I saw what happened with the slowing of home sales because interest rates were going way up and everyone was spooked by what was happening. And we also had a big run up in prices. Prices went up 40% and 50% in some markets like that. And if you have that type of run up in prices, it's never going to be sustainable. That's literally the definition of a bubble. The only reason we haven't had a bubble that popped, so to speak, is because those mortgages were all at 3% and 4%. And so if you have an affordable mortgage, you have an affordable mortgage. And that's not going to force you to sell. It's not going to cause a housing market collapse like we had in 2008. And if that's what you're holding out for, you might be stuck on the sidelines for a while, because even Wall Street landlords are starting to liquidate their properties. And I don't have time to talk about that in this video, but I will in another video. So make sure you're subscribed if you want to catch that when it comes out. And again, if you want me to cover a different market that I didn't talk about in this video, drop a comment. Let me know which city and state in the comment section. And you can even put a zip code in there, and I'll show you how you can get zip code specific data. And one of my favorite tools for that I use with buyers to show people whether or not we're actually getting a good deal or what we should be looking at in a specific zip code. Thanks for tuning in. We'll catch you on the next one. Peace.